So we begin with our top story. Investors increasingly comfortable with a Goldilocks backdrop.
It has been a Goldilocks environment.
Goldilocks.
The driver of that is relatively straightforward.
Inflation pressures remain pretty subdued.
Inflation is moderate.
Lack of inflation. As long as we have no inflation, whether it's wage inflation or other sources of inflation, I think that's how things are going to be.
We're threading the needle here. Businesses haven't lost confidence and continue to hire.
The recovery is ongoing.
The job number's strong, but there's no wage acceleration.
People say, my God, watch the Phillips curve, watch where. It's just not. I mean, we're going to talk about it every month. It's just not going to happen.
All of that points to the fact that things are looking fairly good for the US labour market at the moment.
Joining me around the table here in New York is Oksana Aronov, JPMorgan Asset Management alternative fixed income strategist, Jim Bianco, Bianco Research president, and George Bory, Wells Fargo Securities head of fixed income research. Let's begin with you, Oksana. Does any of that, all of that, resonate with you?
Well, certainly, equity investors have benefited from it, no question about it. However, I think the danger is, some of the rhetoric around the Fed and how it's pivoted, unfortunately, has put it sort of on the indictment path almost in the court of public opinion. And I think it's really dangerous to indict the Fed for any sort of slowdown in the economy, because the reality is that real rates have been exceptionally low, not exceptionally high. I mean, short-term real rates are at 0.3%, which is lower than 60% of the time over the last 60 years. Long-term real rates are at 0.4%, which is lower than 88% of the time over the last 60 years. So I think it's really dangerous to kind of go with the rhetoric that, look, the Fed caused it, and now they're about kind of moving back, because then we're absolving Washington of doing what they need to do to really give us a real continuation of a recovery.
What do you think, George?
I think the bond market has benefited tremendously over the last 3 months. I mean, what the Fed has done is effectively re-liquefy the bond market. We were largely in shutdown mode in the fourth quarter of last year. And by sort of making a big pivot and becoming much more dovish, that really reinvigorated kind of the market overall, brought down yields, flattened the curve, and I think most importantly, got the capital markets moving again. That is sort of the lifeblood of the whole financial system and the economy, and I think that's a big success for the Fed.
That's a big success, and that's the good news. I just wonder to what degree, to what extent that's fueling some complacency. You all saw the front cover of Barron's over the weekend. Let's get to that cover story. The bull market has no expiration date. The author's writing the following: the bull market recently celebrated its 10th birthday. Can it rally for another 10? We've heard it said many times before, but it is worth repeating. Bull markets do not die of old age. Jim Bianco, your thoughts on that?
Well, going back to the Goldilocks thing in that thought, there's an old saying on Wall Street, the price drives news. You want the economic data to be good? Don't worry about the data. Just take the stock market high, and everybody will pick through it. Never mind the earnings, negative earnings growth. Never mind the slowdown. Never mind the inverted yield curve. Stock market's approaching all-time highs, so we're only going to focus on the good stories. That seems to be what we're doing right now. And then you get the Barron's cover to tell you that this is going to last another 10 more years. This is what people write books about, to talk about how highs are made.